This is Ken Boyd, the owner of St. Louis Test Preparation. Here's our website, stltest.net, where you'll find links to all the dummies books. And you'll also find links to all of our YouTube videos on accounting divided by type, which makes it a little easier to navigate. What I wanted to talk about today was a continuation of last time. Last time we talked about a differential and an intercompany inventory sale, and I want to cover a differential again. It's important, but I also want to talk about an intercompany bond transaction, which is difficult, maybe the most difficult intercompany transaction that you have to deal with. So first, to the differential. I'll go through this quickly because it's on the other video that's similar to this. So we assume that Packard, a parent, buys Stacker, a sub. Packard, the parent, buys 80% of the sub. So the first thing we do is calculate the total value of the sub based on the purchase price that the parent paid. So the parent paid $350,000. The parent bought 80%. So the total value based on that payment is $437,500. So if the total value is $437,500 and the parent paid $350,000, that means there's a non-controlling interest that bought $87,500. So once we know that, we then go on to think about, well, what did the parent actually buy? Well, what the parent is buying is the net assets or the equity of the subsidiary. So that specifically is the sub's common stock, their additional paid-in capital, and their retained earnings. So let's look at that as if the whole company was being purchased. So we add that up, and that's $215,000. The difference between the purchase price of the whole subsidiary and the book value or net assets or the equity, all three mean the same thing, for the entire of the subsidiary, 215. The difference between those two, the 222,500, is the differential. The differential is a temporary account that gets reallocated when you do your consolidation. In other words, the differential does not get posted to a consolidated financial statement. So the question is, where do those balances go? The balance, the 222,500 in this case, is either assigned to the fair market value of assets that have a fair value higher than book value, or goodwill is posted. I'm going to flip over to the bond example here in a sec. But the way I always set it up is I put the fair value at the top of the entire sub. I look at the fair values of the sub's assets that are higher than book value. They total 135. I add that to the 215 book value, and I get the fair value of all the assets in green of 350. I put that in the middle. I put the book value of the assets acquired, which we see up here, right here. And that visually helps me see that the difference between the book value and the fair value, 135 gets allocated to those specific assets that have those higher values in consolidation. And the remainder, the difference between 350, the fair value, and the consideration paid, 87,005, that gets posted to goodwill, which is a new asset. So a quick overview of differential. Intercompany bond, the key here is we assume for a bond like this that constructive retirement happens in consolidation. And what that means is we treat the bond as if the bond is retired. That is, that the creditors, the people who own the bond, sell them back to the issuer, and that the bonds essentially go away and they go off the books. The tricky thing is that, and you'll see it in all these test questions, is that the amortization of a premium or a discount for the parent is different from the premium or the discount amortization for the sub. And it doesn't make any difference if the issuer is the parent or the sub, if it's downstream or upstream. We've seen that with intercompany inventory. It doesn't make any difference. The elimination entry is the same. So in this case, Stackner, the sub, issues a bond at a discount, something less than the $100,000 par And we'll say that the amortization method for the discount is straight line evenly each year. The parent, Packard, purchases the Stackner bond after it's issued. It happens to be, if I scoot this over a bit, 4 years after the bond's issued. They, the buyer, the parent, pay a premium. So the bond is issued at a discount, but it's purchased later at a premium. So the challenge is that both the buyer and the issuer have different amounts to amortize, and one guy has a premium and one guy has a discount. So if you think about it in terms of journal entries, on Stackner, the issuer's books, they have a bond payable and they have a discount on bond payable, reflecting the fact that they didn't get the full $100,000 on issue, and that amount, $1,640, is going to be amortized as additional expense. When they issue the bond, 4 years later, Packard buys the bond. The parent buys the sub's bond issue. They create an account called investment in subs bond, Stackner bond, $100,775. Now you'll note, and this is a note I added on here for the student, if you broke this apart on the financial statements, the bond's face amount is $100,000. That's going to be listed, and you're also going to have added to that the unamortized amount of the premium, $775. That gets added together in the investment. So in other words, the investor puts that bond on their books at the $100,000 face plus $775 unamortized premium. And I say that down here. So how do I consolidate? How do I unwind this transaction? Because we need to remove a bond payable for the issuer, a bond investment for the buyer, and any premiums or discounts related to both of those. And I wrote also that Stackner issued the bond at a discount. The parent purchased the bond at a premium. And, to make it more complex, the purchaser bought the bond 4 years after it was issued, so we have to adjust all that discount up to the point where the buyer buys the bond in the open market after it's issued. So the point is that regardless of the timing of when it was issued and when it was purchased, this entire discount on bond needs to get credited to be eliminated in consolidation. The entire $775 also needs to get completely amortized as a premium, so it gets eliminated in consolidation. So we debit to remove the payable, we credit to remove the discount on bond payable. In total, some of it will already be gone after when the purchaser makes their purchase of the bond. The point is it all goes away. And the debit that was on the buyer's books is credited, so that all goes away. Now there's a difference. In other words, in order to make debits equal credits in our adjustments, we need a 2415 debit to make everything balance, so our adjusting debits and credits balance at a total of 102,415. Because it's a debit, we recognize in consolidation a loss on constructive retirement, meaning that in consolidation, when we essentially remove this bond issue and this subsequent bond purchase, and we unwind everything, we have a loss in constructive retirement, which means that the discount expense to the issuer that's taken off the books is more than the premium $775 that the buyer paid. So we unwind all that by posting a loss on constructive retirement. And what our result is that the bond payable, the investment, the discount on bond payable, and any premium the buyer paid all goes away in consolidation. So in consolidation, we have no balances except for the loss on constructive retirement. So that is eliminating an intercompany bond transaction by assuming constructive retirement. That's as far as we'll get right now. Remember that at the website stltest.net. You'll find links to our tutoring services, one-on-one online tutoring, the dummies books, a fourth dummy book coming soon, and links to all of our videos. Thanks very much for watching, and we'll see you